Good morning and welcome to your macro outlook for Monday, September 21st, 2020. Patrick Soresna here. Every Monday we go through our macro tenets. Let's quickly punch through them. Number one, the most reliable way to forecast the future is simply to try to understand the present, and being able to grasp the unfolding realities before us is such a core part of being able to get a good pulse on what's developing and how it's going to play out. Number two, remembering that the market is not made up of currencies, commodities, stocks, and bonds, but it's rather made up of investors, traders, and bankers making decisions about those assets. Remembering the behavioral element of the markets is incredibly critical in order to be good at this. Number three, while markets will diverge for extended periods of time, over a long enough time period, mean reversion to its fundamental value is a universal truth. Fundamentals do matter, and many people anchor themselves on this. But we must never forget that while fundamentals do matter over the long term, over the short to intermediate time frame, prices are a function of liquidity rather than their fundamental value. And this is where a lot of traders get a disconnect. They anchor themselves on something they believe is fundamentally true, and then they get railroaded by liquidity. For us to be good at this trading, we have to learn the balance between the two, anchoring on fundamentals and respecting the liquidity on the interim. Number five, when everybody is in consensus, something different almost always happens. All right, let's just jump right into the market and see what's going on. First off, S&P 500 breaking down. And so where is this most immediate move going? So we're now below that 50-day moving average. Let me just put it on there so everyone can see where that is. And so with this broken, the 200-day moving average is a magnet. You can see that 200 days right around 31.26, and as well. So when we just do, so imagine this just being a zigzag market correction like this. You can see that the measured move of the zigzag also conveniently measures right to the 200-day moving average. And so at this juncture, 100 further S&P points to the downside is pretty much the path of least resistance. There will be zigzags along the way, attempts to shake shorts out of their positions, but this is definitely the most immediate path that we're looking for. And that's really where all of the big tells come in, because if the stock market, just in a nice orderly fashion, was to finish this move down to here, not make lower lows, kind of maybe a little fake out along that 200-day, and then began a rally off of that, then would we say that this was nothing but just a proper 15% market correction? Well, let me just see what percentage that would be. I don't want to make shit up here. That would have, and yeah, a 15% market correction, or 12, 13, 14% down to the 200-day. I mean, that's pretty standard. Now, I personally think it could get a lot uglier and a lot worse. But the first objective we have is to target this down along here. That will be an action point for us to find some way of locking in for a reactionary move. And then we're going to find out whether the floodgate really opens, because structurally there will be massive readjustment of there would be massive readjustment of traders' positions. Like you'll have vol targeting funds have to start unloading aggressively. CTAs will start flipping almost all their long equity positions. Technicians who were all believing that this was a brand new bull market will suddenly see break of trends and make them all have to play defense. There's a lot of selling that can really start to materialize on the other side of this. Will we see it is one of the biggest puzzle pieces for us to solve, and that is what we are going to be watching for sure. And so so let's see if I break this down to the hourly chart. I'll just show you on a 4-hour chart. Actually, I want to just show very quickly. So on a 1-hour chart basis, we just finished this hourly swing trade, and so this current retrace that we're seeing in the early parts of this morning is going to be that bounce. We could arguably even bounce 30 S&P points more to the upside, but it would still be a sell on the you want to fade any rallies. You got to stay on the short side of this market down toward our target zones. I think that that's the simplest and best way to approach this at this moment. Is this on the dollar that inverted head and shoulders, was that simply the right shoulder of that inverted head and shoulders pattern for the bottoming formation? Like we were saying, we want to see the breakout of this out of this zone on the upside for things to really get going, and that is the equivalent of a euro head and shoulders formation, right? So the pattern, the dollar index is pretty much the inverse of this. So are we witnessing some kind of, I'm obviously just some form of a variant of a head and shoulders style formation? You can see how critical the euro break of this 117 level is going to be to discover whether or not the most immediate move will be a mean reversion down to 115 or something like that below. Definitely what we're watching. Pound sterling, a little 1 week flagging formation rolling back down. That would send the pound sterling down towards the 125, 123 zone. That's where all your high volume nodes are lying, right in this consolidation zone. This is definitely a place that if the dollar is going to rally, the pound's going to find its way down into those zones. What's interesting is the Japanese yen continues to behave as the risk-off asset, and I find this interesting. So while we're seeing the U.S. dollar doing well against most currency pairs, the yen is actually seeing money flow, and that's worth noting. It's bucking the trend, and that's it's not what I thought should be happening, but it is what is happening. The U.S. dollar against the Chinese renminbi finally getting some bounces here, very oversold, and if we see that the euro's breaking down, the renminbi, the People's Bank of China is pegging to a basket. The euro is a key part of that, and so it will be hard for us not to see a reflexive snapback in the U.S. dollar against the renminbi if we see the euro breaking down. The Canadian dollar looks like it's rolling over. This should send us to 75, 74.5 cents on the downside. We'll see what the next move there is. The same with the Aussie dollar. Failed attempt to break to a higher high. Starts to look a little bit toppy. Will we see the big breakdown that will send the Aussie dollar down towards 70 or 69 cents? All of it's on the table. Bitcoin, this it's almost like the crypto guys are using fibs. It's like you got these 61.8 test, rollover, break of the wedge. If this is the break on this flag, that's sending the crypto down to the bottom of that consolidation zone, just around 9,000. That would be where you could see the next break on this really start to emerge. Let's talk commodities. Crude oil. Now, again, there's a lot of people that were very excited about the snapback, but considering where risk assets are and the risk that the whole stock market is highly vulnerable here, it's hard to imagine oil not feeling some sort of a catching a cold from the flu that the market gets. We still cannot rule out that if the whole market downdrafts, that oil takes one more trip down in establishing this. There should be no confusion that I believe all dips should be bought, but I just don't know if I'm confident enough to say that this is all upside from here on oil. I feel that there's plenty of room for this to zigzag and fake out here. Be careful on being overly confident that oil is just straight up from here. It's probably going to be far more noisy, but you should be buying dips on it. And that you can see here on gasoline futures that the way I would envision that playing out, and this is a little bit of a cleaner version of the chart. Now, obviously, this is a continuous chart, and that was a contract roll. So, there is a little bit that be suspect about the technicals on this, but it gives you a good idea of what we're talking about on oil, which is gasoline futures could zigzag down to $1 a gallon. Down into those zones, and that would be where you would have a compelling buy on dip on all of these, right? And so that to me, I think, is a reasonable way of approaching all of this. Interestingly enough, this is the continuous contract on natural gas. I think that they're just giving it to the natural gas ETF, the UNG, as it's stuck doing its major roll of all its thousands of contracts into the next month. And they just threw this into a super contango. You'll see this as soon as this rolls, we'll have a monstrous gap higher. Like you're going to see one of these scenarios where there's going to be once the contract roll occurs, there's going to be this bullish candle high because it's going to roll to and start tracking the next contract, and suddenly nat gas will be doing this. And there's no way for you to profit from it because you have to be right now to get this price. You have to be in the front month October contract, which is about to expire. And so this is just it's complex. Let's just put it that. Copper continues to behave very well. Higher highs, everything is working. I like it, but will this kind of get downdrafted on a bigger risk off? We'll find out. I do like copper, but I think that it would be favorable for us to get a compelling buy on dip on this. If we saw a nice scenario where this actually got caught up in some sort of a liquidity event and downdrafted, then we would have an opportunity for us to reposition on our favorite copper plays at a good price. I continue to believe uranium is a great buy on dip. I'm not going to change my view. Gold may very well. Think of it this way. We're in a risk-off period. We could have risk assets being all kind of tossed around. Money flow to bonds will be kicking in. So they'll be influencing real yields. And at the same time, the dollar should be doing well in this environment. All of those things could behave as a headwind for gold and silver, which could resolve this triangle to the downside, which again would be in that scenario where gold downdrafts towards 1800. That to me is a gift. Like you can see the 1840s, this fib, the bigger fib is down to even as low as 1700. I don't think we have to go that low, but you have this major congestion point right in here. I mean, if we see gold break this pattern to the downside, could we see a trip down to 1800 or 1750 in a quick liquidity surge that gives us this great opportunity to reposition for an upside on a dip? We have our hedge wraps in, and if that's what's going to happen, we'll deal with it. To me, I'm buying every dip on gold. If gold does that first, then it's just going to be an opportunity for us to reposition. And that's the same thing with silver. The silver failed to rally, rolling over here. Maybe silver will, if gold makes a break, maybe silver is heading down a little bit in here. If you're selling premium on silver, have an imbalanced thing where if you have 50 contracts of your anchor hedge, and you're selling short term, sell like 25 or 30 of the short term ones and be over hedged. That way, if we do get caught in a liquidity event, a downdraft silver, then you could turn around and be over hedged and then be able to sell premium into the volatility and actually make yourself good on a readjustment. And so just be tactical about it. Now we had obviously Angie come on, gave us a good rundown of what's going on here. Look, all of these are somewhat in the moves have already engaged, and therefore there's not much asymmetry when you compare what could happen on a downdraft versus how much further upside there is. It's basically 50-50 at best. And so while there's room for these to continue to move a little bit higher, I think that they're very mature. Like even corn is not far from all of these previous highs. Soybean is, while it's ripped amazingly, it's approaching all these major consolidation highs in 2017 and 18. The point is that the money's already made in the grains. It's hard to justify telling any of my members to start their buying operations here on this stuff. We'll see. Anyway, 10-year Treasury bond trying to tick up. Will we see this break higher? Absolutely. The market is getting its face ripped off. This is a period where money will flow into the Treasury bonds as safe haven. This is something, unfortunately I'm on the wrong side of the bet with Kevin on this. Is why we kept it as a Duke and Duke. But I personally think that this 10-year Treasury yield could very easily return back to 50 basis points and even go down to 35 basis points if the stock market really gets messy. And so, nonetheless, let's go to global equity. And this is where I think the real story is of this whole scenario. First of all, let's look at Russell and NASDAQ. So Russell just rolling over. This is where we could see some selling kick in. NASDAQ breaking to those lower lows below its moving averages. Let's just quickly give context on this. Notice here we're below the 50-day, the 200-day moving average on the NASDAQ, which is at 10,000. It's another 800 points. And there's plenty of times where the NASDAQ is traded to its 200-day moving average. You can see that that's still a wee bit away. And that's just the reality that there's more downside risk on these tech names as they're giving that back. So I really want to talk about global equity, though. And so I want to start with that Euro stock because this was the canary in the coal mine for me. Up until last week, the global, the developed market, the developed world markets have been very quiet. And this was really about the FANG stocks getting their face ripped off. Now, I was saying, in order for there to be a broader sell-off, you need to see the broader stock markets of the world get caught up in the mess. And there's a broader deleveraging of risk that happens. Look at this breakdown candle this morning on the Euro stock. This, to me, is what we were looking for. The idea that global equity is starting to now notice and get nervous about this. Now, Nikkei has held up. Okay, so Nikkei, but I mean, Japan seems to be in its own little bubble, and we'll just have to accept that to be true the way it is. But you got the Canadian TSX, which is going to open down pretty hard. You're going to have look at the way the failed rally attempt in the India Bombay market as it comes back, retests the high, breaks down. Looks like we may have this rollover. The Chinese stock market, the China A50. Failed rallies, not doing much. You can see the breakdown now coming in the Australian 200. It's a failed rally rolling over. You have Brazil basically very weak. Will this downdraft and break? I think so. Look at the way the London FTSE slammed today, right back down to the lows. We now finally have a scenario where global equity might have the feet kicked out from underneath it. And if that's the case, that's what's going to create a much deeper, broader sell-off that's going to really slam the S&P 500. And so let's see whether this all happens right now. Look at the Kospi. Is that going to prove to be a double top as this trend line breaks in the South Korean index? And will emerging markets finally see the break today? And that's all things that I think are worth watching 100%. Finally, volatility is upticking. Listen. Whatever happens here, we have to take profits on the VIX into whatever surge we're about to get. Our back spread cannot be held till the October expiration. And so we have to just take whatever the market's willing to give on this move. If we get a proper surge in volatility towards the VIX at 40 or something like this, there should be no confusion by members what needs to be done. We cannot hold back spreads into the final 2-3 weeks of their expiration. That is a no-no. And so therefore we really have a couple weeks at best, a week or more this week and maybe some of next week where we can make this happen. So whatever the market gives us on the upside, we take it. And that's we'll leave it at that. Anyway, so that is your rundown of your macro outlook. We will be on for Where's the Trade. Lots to talk about on this stuff. So I'll see you all online then. Thanks, everyone.